Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This Analyze Out Loud video is at the request of a subscriber to our YouTube channel wanting to take a look at the company Take-Two Interactive. I do want the viewer to understand that this is not a company that I have followed, so I know very little about the business and what it does. I generally know what industry it's in, but it's not something that I'm personally intimate with. So what I'm really going to do here is just take a look at the fundamentals based on the numbers. Now, a couple of things strike. These are monthly closing stock prices. I'm going to take price off of the graph, and I'm going to take the normal PE, and I'm just going to look at the company's operating history. The first thing you see is a great deal of cyclicality, where you have earnings, falling coming into the recession of 2001. You had, several years of earnings declining. And by the way, their fiscal year is March. From March of 02 in through 07, they actually had negative earnings or losses. They lost $1.15 in fiscal year 06, $1.13. Then they had a really good year, and then they had another loss. And more recently, if you look from 2013 on, you see a little better growth. So one of the things that I think has happened here, if I put price back on the graph, you can see that coming in this period where we had this improvement in earnings, we've had this enormous run up in price, but now we're starting to see some volatility. Now, in my view, what you're seeing here is a stock that's gotten ahead of itself. So let's shorten this graph down to just this period of time where earnings growth has been excellent. The growth rate of earnings here is 21.2%. You can see earnings went from $1.96 to $2.62 to $3.35, and then are expected to be $4.35. The E stands for estimate in 2019, followed by 9% growth, followed by 32% growth. So this forecast of future growth, coupled with the fact that they did put together 2 really good years of earnings growth here, has obviously created some enthusiasm for the stock. And like it does happen a lot of times, especially with growth stocks, now the valuation has gotten ahead of the earnings. Now, one of the things that I like to look at when I'm looking at valuation on a growth stock where I don't have some of the traditional metrics like dividends and where cash flows aren't as important, let's just look at some of the basic statistics. Obviously, the company pays no dividend. It's a $13 billion market cap. It's not rated by Standard & Poor's, and it has 0 debt on the balance sheet. Now, that's, to some people, a really good thing, but the company has been growing here recently and is expected to continue growing into the future. So let's look at forecasting for a moment, because that's really, I think, what this is about. Like I like to tell people, you can't invest in the past, you can only invest in the future. So there are 20 analysts that are forecasting growth of 29.85% for fiscal year ending in March of 2019, or the next fiscal year. Then there are 17 analysts that expect the following year to be 9.2%. Now, I suspect that has to do with launches of new products and so on that the company develops. But then there are 7 analysts that think it's going to grow at 30% rates again. Now, and there are 2 analysts that think they're going to have a super year in 2022. I find it very difficult to look at estimates going out more than 3 or 4 years. In fact, I like the 1 to 2 year estimates the most. So let's look at their analyst scorecard. As I showed you earlier, the company's been very cyclical. But over the last 5 years, analysts have been doing a pretty good job of getting the forecast correct. A year before the actual earnings were released, they forecast $2.04 for 2017. The company actually came in at $4.26. Then the next year they forecast $2.04. It came in at $4.28. So these are significant beats, if you will. The company has really been doing extremely well. So at this point, the analysts have been reasonably accurate, so these numbers could actually be understated. That's something to consider here when you're talking about valuation. Based on the actual numbers that are being forecast, I would say the stock is overvalued. Now, another thing I like to check, the PE ratio currently is 33.3, which is excessively high. If I put the normal PE here over this time frame, it's been about 21. And I'm going to go down to these forecasting calculators again. I'm going to go to the normal PE calculator, and I'm going to look at what type of PE ratios the market has traditionally applied. And it's really been in the 17, 18, 20 range. They did get as high, more recently as high as 26 times earnings as a normal, but 18 to 20 times earnings seems to be more normal here. So, I would like these valuation levels here. Now, let's assume that those estimates are correct at first. that would actually indicate a negative rate of return. Now, if they're understated dramatically, then of course what I'm saying here could be an error. But again, the company's been beating estimates here in recent years, and that's something to consider when you're doing your analysis. But let's look at earnings yield for a moment. If you look at the current earnings yield or next year's earnings yield, the company's earnings will only represent a 2.7% yield or rate of return, if you will. In other words, that's the inverse of the PE. Instead of the price divided by earnings, it's earnings divided by price. And that's simply saying if you got all of the earnings, which you don't get any because the company doesn't even pay a dividend, but if you got all of the company's earnings, your return would only be 2.7%. But the stock clearly has momentum. If I expand this out a little bit, you can see they've had some pretty good earnings growth here, and the stock clearly has a lot of momentum. So one of the things that you would want to do if this looks interesting to you, if you owned it, the first thing I would do is I would go, of course, into the company's website, and I would look at their business, what they do, what kind of games they are. I'm not a gamer, so this doesn't mean a lot to me. But I would also want to go into the corporate section of the website, and I would want to look at any presentations the company might have done. I'd want to look at their annual reports. I'd want to look at here's their latest investor presentation. And one reason I like to do this, and I want to make it clear, when you go into these things and actually look at these presentations, and I'm launching it right now, what happens is you can often find the company's guidance in here as well. And what they think the market opportunity is going to be. Here they're saying the global video game market, they expect to grow by 6% on average through 2019, or that's what expectations are. They talk about how many people they have. Again, I don't want to spend time for this video doing this, but this is where you would go in here and look at what's really happening to the company, and even look for guidance on what the company might be suggesting to analysts that they might be able to do going forward. Now next here, I'm going to go into financial underlying numbers, what we call fund graphs. I'm going to look at some important balance sheet items for a company like this with this kind of cyclicality. What I've shown you here is essentially the company's cash and equivalents per share. And you can see they've had 11, 12, 9, 10, and currently as of March of 2018, they had $7.35 a share in cash. But that was per share data. Now I'm going to go into what we call the in millions graph, and that translates into about $800 million of cash on hand. Now there's another metric that I have highlighted here that I think it's important for investors to realize. The company has been issuing shares. Now that's actually a positive thing from the standpoint, if you think about valuation, they've issued, if I just shorten this just to the last couple of years, they've gone from 80 million shares to 107 million shares since 2016. And the reason I say that is good, the company is actually issuing shares, or they're raising capital when the value of their stock is extremely high. That's more or less a good thing. I hate to see a company buying back stock when the value is high. But if they're going to issue or raise capital to fund their business, they're doing it at an opportune time here. And I think that's kind of an important consideration that you might want to think about. In closing and to summarize, this is again not a stock that I'm real familiar with. You'd have to decide whether it's worth looking at or not. You can look at a lot of different valuation levels as you go through different time frames, but the company has been doing extremely well as of late. I'd want to know why and why I expect that to continue in the future. Looking at the earnings forecast, the analysts are expecting pretty decent growth, but once again, I would think valuation is a little high. I want to remind you, though, that the forecasts have been understated here recently. The analysts have been underestimating what this company is capable of doing. So you want to take all those things into consideration, but even having said that, I would still consider this a fully valued, if not significantly overvalued stock. This has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video.